Strategic Income Opportunities Fund has and always has been an absolute return-oriented fund, which simply put means I'm trying to generate positive returns through the market cycle. It doesn't mean the fund's going to be up every single day, but over a market cycle, I like to see positive returns regardless of the direction of factors which typically impact traditional bond funds, which includes the movement of interest rates as well as the movements of things like credit spreads. Yeah, the fund's done very well over short and long-term periods versus traditional fixed income indices and traditional funds. Typically, it's outperformed over most market cycles. It's had positive returns generated in periods where fixed income indices tend to not do well, including periods of rising interest rates like the one we're in right now, where the fund has been able to generate positive returns despite the fact that interest rates have risen significantly off the lows of a couple of years ago. And again, that's by design. We try to never have this fund overly reliant on a single factor. And that's very, very different from what you see in the traditional fixed income universe, where most funds are very, very sensitive to movements in interest rates and always have been. Now, that's been a very good place to be for the last 30 years as interest rates have been falling for that long. But now that the Federal Reserve is out of the picture, interest rates are rising, we're trying to get back to something more normal, fixed income fund performance is very difficult to come by. And that's where having an absolute return-oriented fund as a diversifier in your portfolio becomes extremely important. Since the fund was launched nearly 10 years ago, it has been able to generate market-beating returns, certainly relative to traditional fixed income indices, over the cycle. And really, the last 10 years have been marked by a period of falling interest rates. So that's important because we really haven't benefited from that in this fund. We really haven't had much exposure to interest rates. But despite that, we've been able to beat these indices over that period. And we've done so with significantly less volatility than these traditional fixed income indices and funds, as well as very low correlation, low to zero correlation, and even sometimes slightly negative correlation to these traditional products and indices. There's three distinct pillars to our investment process. One is called beta, or sector rotation. And that's simply, looking at the market, finding attractive areas for long positions and taking advantage of them when they're worth taking advantage of. That opportunity set is constantly changing. Like, for instance, I'm not going to buy something if it's extremely expensive. That just doesn't make sense. I'm going to wait till it cheapens up. That could be an opportunity. The second part is our alternative sleeve. Now, that typically is long short positions. And long short positions can be in credit, for instance, they can be in rates. And again, it's anytime I see an attractive relationship that seems out of line with where I think it should be or with historical norms. And we use that sleeve quite frequently. The third sleeve, which is very important, is our hedge sleeve. Now, those are typically short positions, but it also includes cash. Cash to me is the ultimate hedge. It allows you to be liquid. It allows you to take advantage of situations and you get paid to hold it. And the more the Fed tightens, the more you get paid to hold that position. It also includes short positions in the fund. Now, these could be positions that are trading very, very expensive on a historical basis, where it's very, very cheap to short them and protect the rest of your portfolio, including long positions, against any downturn in the market. And it's always been an important component of the fund. And short positions will continue to be an important component of the fund going forward. You cannot run an absolute return strategy, in my view, without incorporating short positions into the portfolio as well as cash. I have a wonderful team based in Boston that helps me accomplish my goals. And I think it's extremely important to have three things when you're running an absolute return-oriented strategy. And that's one is dedication. In my view, if you're going to run an absolute return strategy, that really should be all that you run. You shouldn't be running other strategies with it that are long only or short only in conjunction with them, because it causes you to lose your focus, again, in my opinion. The most important thing to me, along with dedication, having a dedicated team, 100% committed to handling absolute return-oriented funds, is accountability and transparency. Now, what I mean by accountability is, the buck stops with me. If people don't like the performance I'm putting up, if they disagree with me, they know where to go. And I'm not going to point to other funds that are doing okay and say, well, look at this fund that I'm running. That's not how I work. Accountability is everything. Transparency is very important too. I do a monthly call with my investors every single month to tell them exactly what I'm doing, what moves I've made over the previous month, as well as what my outlook is. And I think that's critical as well, along with the data output that we provide. And finally is performance. At the end of the day, you can have all the dedication and accountability in the world, but if you're not putting up the numbers and you're not providing the volatility profile that people want, they're not really going to care about the prior two. So at the end of the day, performance is also what matters. And again, when I look at the numbers that this fund has put up both over the short and the long term, I'm very pleased with what I see relative to traditional fixed income indices and traditional fixed income funds. The last 10 years for me as a portfolio manager have been really, really good. I've been able to provide very competitive returns with low volatility and really no correlation to traditional fixed income indices and funds. And that's important. That's what I promised to deliver. I like to believe we did deliver that and more, to be honest with you. I'm really looking forward to the next 10 years when I think our message can be even more powerful and our process can prove even more powerful in an environment that's not characterized by falling interest rates and central bank intervention that's unprecedented in nature. When that stops, when that music stops, you have to find innovative ways to grow assets. You have to find innovative ways to provide returns. And I think we're capable of doing that because we've been doing it for nearly the last 10 years.